Well, hello everyone. Thanks for joining today. My name is Shiv, and I'm a consultant based out of Los Angeles. I work in the Big Four tech consulting space. But today is not about me. Today is about my conversation with Sundip. And Sundip is he's a seasoned portfolio manager who's been on Wall Street and related firms for the last 15 years. He's had experience with firms like ING and Ashmore, and we'll go more into his background, shortly. But before we do all of that, 2020 was an interesting year for all of us. For different reasons, we know that, and 2021 too. And but one thing's for sure, like at one point, I thought I was doing really well with my stock portfolio, and now suddenly, I don't know why I am in a lot of red, and so that's the one I want to start my conversation with Sundip about is at one point I thought I was doing really well, but now my portfolio is, to be honest, is more than 40% down and in red. As an investor, like, how do you think about the situation and what should I do, in your opinion?
So, Shiv, if at any point an investor is down more than 25-30% in their portfolio, the first thing you need to ask yourself is, where is the market headed from here on? If that answer is, I don't know, the market is in limbo, I have no idea, it can go down a lot more. If it's any one of those answers, then what you need to do is cut your losses. You need to right away say that I have no idea what's going to happen, and you need to cut your losses. On the flip side, if you identify the one or two key reasons why the markets are down, and you believe that those reasons are getting less worse, in that case, you need to break up your portfolio in two buckets. Bucket one are names which are good businesses, which are in the right themes, which you believe will make a comeback. It's just a matter of time. Strong balance sheet, strong cash flow, great business model, etc. That's bucket one. Bucket two would be names that were the internet fad stocks. Stocks that were spoken on multiple internet forums, stocks that were pushed by multiple TV channels, stocks that were very popular for multiple reasons, but did not have the solid backbone of a well-run company, that did not have solid fundamentals backing it up, that does not have a significant generation of cash, that, is a business that was just, pushed higher through the different channels that people use in the investing business. And in those businesses, again, you need to raise your hand, say, I made a mistake, and cut your losses. Whenever you're down to that extent, something is not right. You did something hasn't worked for you. Something has gone wrong, and it's very important to identify from a top-down approach what is happening in the bigger picture, and then from the bottom-up approach, you try to figure out where have you made mistakes which need to be cut right away, and where have you made investments just a little too early, but you believe that they will eventually flow in the right direction.
Okay. So when you're talking about like those push businesses, like, Peloton is one of them, at one point, it was, 50 and lower than that. And, and then it at one point went to it tripled, or it went to 160 or so. And now it's lost more than 70-80% in value. It's down to 20-25. So that was one of the stocks which did make me money at one point. So is it just me saying, okay, now Peloton has not made me money, okay, so I cut my losses, that's fine, but then now what? When you say these other things have changed, how do I reevaluate, what do I do with that that money and recover my loss?
You cut your loss. You basically take profits. You sell those businesses. The business. So so when you buy a business like that, right? It's never an investment. It is a lot more like a trade, right? And if you've stayed your trade for too long in terms of duration, then obviously that's an error. That's a mistake, right? So then by default, you need to exit, right? If you made an investment in a business like that, that's an exit for sure, because that's not how investments are made, right? So if you have come to the conclusion that one of the businesses that you have invested in
Right.
is either not sound in fundamentals or doesn't have the right, positive momentum behind it in terms of earnings,
Yeah.
or it's just a business you don't understand, you need to get out. A great example of that is some of these fintech companies. I don't want to name
Right.
names for obvious reasons,
Right.
but a lot of these fintech companies are out and about, where the
Right.
entire business model is to
Hmm.
lend them money and lend
Right.
who money? Lend money to people who have a very poor credit score,
Okay.
right? And so what happens is, when after a year or two of significant growth, when the actual time comes for these people to pay up, you start to see a much higher default rate, right?
Right.
Now that is one problem, right? That you're seeing
Yeah.
rates, default rates going higher. And the
Yeah.
second problem is the Federal Reserve is raising rates by
Right.
125 basis points, maybe more,
Right.
uh,
Right.
by the end of, by 175 basis points rather, by the end of this year. And what you're going to see a significantly higher cost of funding for a lot of these businesses, right? And
Right.
so then with the higher default rate and the higher funding cost, where do valuations stand? Those
Right.
price to book metrics on some of these companies will change very quickly. So
Right.
you need to spend a lot of time trying to assess
Hmm.
where the fundamental momentum is behind some of these stocks. And if it is not in your favor, there is no shame in saying, hey, you know what, I made a mistake, I need to get out, because you can
Right.
always get back in. You can always
Okay.
find themes that are working much more in
Okay.
the near term and in the midterm, versus themes that were once a very popular theme, but on
Hmm.
on further introspection, it seems that, wait, hold on, maybe there is a problem, and maybe investors will not pay beyond a certain multiple for these stocks, right? So always, if you have made an error in anything in life, if you've made a
Yeah.
mistake, it's
Yeah.
best to say, I'm out, step back, reassess, and come back.
Okay. Okay. No, no, it's a valid point. But like I'll be honest, right? Some of these things you're talking about might come a little easier to you, right? But for someone who's a newer investor, like myself, or friends I have, like sometimes we look at the fundamentals, but like the market has a mind of its own. The timing may not match. There might be stocks which still run, and you end up having some element of, like, even though, like, I'll admit it, there's some element of gambling which happens, and you see some really good returns, and in your mind you start thinking, oh, like, maybe I'm going to get that return again, and maybe I won't get that same return if I invest in like a really solid business. Maybe I'll get some, but maybe I won't recover my loss. And like, in I know, like, this goes more into like emotions versus whole thinking. So, like, when you talk about these topics, you seem to have a little more insightful or seasoned approach. So how did you develop that approach, or how did you learn this? And how do you emotionally, like, deal with these decisions, because there's a lot of emotions involved, and there's like a hope involved too, right? Because you saw historically that stock going 5 times or whatever, and then you're thinking, oh, maybe it'll go 5 times again. So like, what's like, how did you learn this? What's your, what was your journey over the years, and like, how did you get to where you are, and like emotionally, how do you deal with it, so that like, we can get some insights? Because sometimes, like, the things you're talking about, they make sense to me, but I want to understand better how you think about them. Yeah.
Sure, that's a great question, Shiv.
Yeah.
I had the fortune of having several mentors while I was getting into this business and learning this business. And while they all teach you a few do's and don'ts of the business in terms of reading balance sheets or looking at certain themes and etc., but no one can teach you how to manage your emotions. That is a very, very difficult uh, 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 skill, and that is a skill that you need to self-develop. And really, it
Right.
boils down to two things. First is that when you come up with a game plan or a methodology to
Mhm.
invest, that does not just include the buy side of the equation. That is 50%. The other 50% is how to sell, right?
Okay.
And so hopefully, you've gone through the learning curve, you've paid the tuition fee, you've learned, you've made your share of mistakes, and you've learned how to, how to buy and how to sell right. Once you have figured out that plan, you need to be extremely disciplined on that. And that is, way easier said than done. And I think that is one of the main reasons why most investors or traders fail, because it's very difficult to stick to the discipline. Very, very often we pursue our intuition. But my opinion is that our intuitions are set up to deceive us, Intuitions always have a strike rate of 50-50, maybe more over the long term. At least mine do. I don't have that kind of intuitive ability. But my opinion is that our intuitions are set to deceive us. So you need to come up with a clear set of rules on the basis of your investment or trading philosophy, and you need to follow them to the T. You need to be extremely disciplined. That's point number one. Point number two, that helps me a lot, is I detach myself completely from the outcome of a trade. I completely detach myself. It's just one of the trades. I'm going to probably take 30 trades in a year, 30 bets in a year, and some will not go right. And it doesn't matter to me. I'm completely okay with that. So when I'm going into a trade, or when I'm going into an investment, I very clearly know the 2 or 3 outcomes that are possible.
Okay.
Either I'm going in and boom, it's off to the races, or I'm going in and it's consolidating, or I'm going in and it cracks and it starts to fall. And I mentally prepare myself that these are the 3 possible outcomes. I visualize them. And if it goes south for any reason, I have a very clear number at which I'm going to say, you know what, this is not working out. The stock has broken a very significant level. And the fundamental reasons that I believed are critical are not panning out. And so I'm going to say, you know what, this is not working. It's no problem. And I will exit that trade. So I never beat myself up over a losing trade. If it hasn't worked out, it hasn't worked out. I would beat myself up if my ego gets in the way. And I'm saying, oh, wait. This will come back. I know it's going to come back. I've done all this work. It will definitely come back. That is when the problem is, right? That's because the truth is that there are multiple things I would not know. There are multiple, I cannot be the master of every sector or of every bet I make. There are many, many things I would not know. And to have that safety net is extremely critical. So that is the way I do it. I have discipline and I have detachment, and I use those two tools to manage my emotions.
Okay. So basically, you can't be a cheerleader for your own stock. Be like, it's not gonna go up, right? So no, but that makes sense. I know it does sound ridiculous when I say it, but some of us tend to do that, right? We don't cut our losses and we just think, tomorrow maybe, tomorrow, like it's just a emotional thing. So it's very helpful to understand like your detachment approach and like your philosophy. So like, then in that same realm, like, is chasing stocks a bad idea? Like, like sometimes you see a stock like flying and, you want some of that, action, or, you thought you think I'll just make like some quick bucks and, I'll get in and get out. Like, so like, what do you think about chasing stocks? Like, is that, a good idea in, any scenario?
I would never chase stocks, but again, chasing has to be defined under parameters, right? So if something is up 5% on a day, but I believe the upside is 65%, would I chase it? If it's up 5%, of course I would, right? Because I wouldn't care about something that's that small, right? But if the upside is 30% and the stock is up 15%, I wouldn't chase. The risk reward is not in my favor. So for me, chasing would always boil down to what is the risk reward. If despite a stock running up, I'm still at a point where I believe my risk is a certain number and my reward is times 3, times 4 that number, I would not shy away from that bet. So it'll boil down to the risk reward.
Okay. So, when you're talking about risk reward, or although I'm making fun of myself, like sometimes I feel like I do understand a business all right, and then I'll try to invest in it. But like some of the trends you're talking about where, I think it's, it has an upside of 65% you said, or 30% you said, I sometimes think I know that trend, but I really don't, to be honest with you. It's just my educated guess or educated analysis. So how do you identify a trend? When you're talking about these trends, like how do you identify it, as an investor?
Sure. You have to always ask yourself, where is the world headed? Mm-hmm. And you have to ask yourself that at a point when there has been a crisis. There has been a crisis, there has been a crash, there has been a disappointment of some sort in the stock you own, in the sector, in the markets, because of which a very good business, a well-run business is down significantly, right? And then you have to ask yourself, okay, what are the 1 or 2, 3 reasons why the stock is down? Okay. And then if you believe that those reasons are temporary, then you spend significant amount of research on trying to figure out why is that temporary and when will that turn happen, right? So my themes or my trends that I follow would very, very closely be attached to this, where I would basically be working on sectors where I believe that the turn of events, the positive momentum will be coming the fastest. Right.
Okay.
So it would be a sector where there's been a disappointment. It would be a theme where I believe, a turn is coming very, very quickly, and I would spend a lot of time doing that. So a great example is, in the face of crisis, in the face of Russia attacking Ukraine, markets were down quite a bit that day. And what we did was we went out there and we bought a company called Nutrien, NTR. And the reason we did that was because Russia is a significant supplier of fertilizers around the world, even to the West, right?
I see.
And when you have that supply chain being choked off, that is a significant opportunity for anybody who's a sizable fertilizer player globally, right? And Nutrien is just that, right? They're a large manufacturer of fertilizers globally, right? And so we saw that theme, right? We realized that stock is down quite a bit. We realized things will now get less worse because they are going to have a phase of supernormal profits. And because we believe that phase of supernormal profits is not just going to be a quarter, but several quarters, we were very happy to play that theme, right? So again, so that this example summarizes exactly how we operate, right? We see a crisis. We believe that things will turn very quickly because of a few events or a few points that we have analyzed. And then if we believe that theme is long enough for us to play and no one has discovered it, or they have discovered it, but the market is not paying for it, we will take the bet.
Okay. So I think you described many different factors, right? I think you described about the fundamentals of the business. You described the correlation of external factors with that business, international markets. You describe understanding how investors are looking at it and the timing of these things. So it seems like there's a lot of different factors which go into this. So would a non-professional person, say for example like me or someone some of people who do regular jobs other than full-time investing, would they have time to do this, or or would they want professional help? How do you how do you with good confidence identify a trend, right? And get to it, because otherwise if it was as easy as following those things you told me in 5 minutes, everybody could do it, right? So what's where do the professionals come in here, or versus what we can do? What's the deal with that?
So Shiv, I believe that anyone can play the investing game with a few caveats. The first point I would want to say is that anybody who is a master in a certain profession,
Right.
If you work in an oil rig, for example,
Right.
I'm pretty sure that you would be able to analyze or feel the pulse of that sector way better than me, because you know
Right.
the lay of the land, you know what the moving pieces are. Um, so I think every individual will have one sector where, which is where his profession is. So I'm pretty sure that they would do a very good job in investing in that sector. Maybe not investing, but analyzing that sector. Investing is not just about starting a good business; it's also about timing, which
Right.
is 75% of the game, if you ask me. Everybody can
Right.
find what's a company.
Right.
An undergrad, while he's still finishing his undergrad, would be able to tell you
Yeah.
what's a business. But timing is a very important part of this, right? So,
Yeah.
so that's the first point, right? Everybody
Yeah.
would have one or two sectors which they would be inherently good at, um, um, which would make them good in analyzing it, but not necessarily investing it, right? But the second point is anybody can be good in investing, but it takes a lot of time. You need to spend at least 5 to 6 hours on a daily basis to be able to come up with a reasonable portfolio. And still, the odds are against you, because some of the brightest minds out of these top business schools spend 15, 16 hours, or some of the brightest minds who have 10, 15, 20 years of investment experience spend 15, 16 hours on a daily basis, have access to multiple resources who you are competing against. So what is your edge? Right?
Correct.
So if you are not at least spending 4 to 6 hours on a daily basis on investing, you need to find a professional who's really good at it. Just because you see a YouTube video on how to do a root canal does not mean that you can do your own root canal.
Yeah, exactly.
That's just the way. So in any field, in anything in life, you need to always depend on a professional. And I think when it comes to money, which is probably as critical as anything, if you cannot give that number of hours on a regular basis, on a daily basis, you perhaps definitely need to seek some kind of professional help. If you're down 25% of your portfolio, you definitely need professional help. I mean, there's no debating that, for sure.
Right. No,
so just to add a little more, so for example, for someone like us, right?
Yeah.
Not only do we speak with a host of management on how businesses are going in a certain sector, and then we speak to a bunch of investment bankers who give us, a lot of financial details. And then we have our internal team of 5 or 6 analysts who go and crunch these numbers, come up with financial models. Then we speak with experts in the value chain, right? Who are either wholesalers or retailers or distributors who, are somehow. So, for example, if I'm looking to invest in a chemical company, I will always speak with a wholesaler who's importing that chemical into the country from, let's say, China. So what is the cost mismatch, right? There are multiple factors, right? So all of that, and then we have a great sense of, understanding how institutional volume is coming into a beaten up stock. So we can, time our entry right? So a whole host of factors are coming into us taking an investment or a trading bet. And even then we get a few wrong, right? Quite a few wrong, to be honest, right?
Right.
So it's not an easy game. It's a serious time commitment. And if you really want to compound your money at 20, 30% every year, which is the real way to get wealthy, you need professional help.
Okay. Yeah. So I think that's that brings us to an interesting point, right? I think, and you talked about all these different things which you or other investment companies do, to be successful. So let's talk a little bit about the investing philosophy, right? You talked about, compounding at 20, 30%. So so what's your, you've managed $1 billion for, more than 10 years, and so what is your track record been? And, what's the right way to, grow money, in this, with in 2020, Fed printed a lot of money, right? So there were a lot of I'm just going to call them lottery stocks, right? You bought them and then it skyrocketed, and but then maybe you made some money, but then you couldn't always sustain that money. You couldn't always find a parlay bet of skyrocketing stocks, so like, or you want to maybe reduce your risk as you increase your amount and maybe slowly compound, like what is, like, you say that's the right way to make money. So can you talk a little about that investment philosophy, and why that's the right way to make money, and how it worked for you when you managed your $1 billion, and then your track record, like, did it actually work for you, or were you successful with it?
So last year we did a return of 36.5%. Our average strike rate has been an average return of 30% over the career, over the long term. And the way we do it is, we invest in monopolies or duopolies or companies which are having a very high market share in their sector. So basically companies that dominate their sector, champions. We invest in champions, or we invest in companies that we believe are on the path to become champions, are on the path to dominate, their sector. So we look to buy companies like that. We look to buy companies like that when there has been a crisis, when there has been disappointment, when something has gone wrong and people have thrown in the towel and they have given up on these businesses, right? So they're down more than 30%. And then we will figure out the one or two reasons why we believe that this sell-off is temporary, right? So we will identify the one or two pieces because of which these stocks are down. And then we will spend a lot of research time on figuring out when will these one or two reasons get less worse, right? And once all of those pieces are fit together, we still can't invest. We have to, we typically like to wait and catch the turn on institutional volume. So when we start to see a significant institutional volume start to kick in on a stock that is already beaten up, down a lot, etc., all of that. So we start to see a significant change in demand supply mismatch. Again, not volume, not high volume driven by retail, high volume driven by institutions. When we start to see that, and so a confluence of all these factors, that's when we will go ahead and buy a stock. So that in summary is the way we do it.
Okay. And then in terms of, like, your investment philosophy, like, like if I have, 100,000, does it, like, like I'm just talking hypothetically, right? Like if, like, not my personal opinion, but I'm just talking objectively, like, oh, do I put it in like a lottery stock and hope one day I have $10 million and retire, and it's okay if I go down to zero, or do I, like, put it in, like, like, how do I grow it in such a way that, I have some confidence that I'm growing it the right way, like, what's in your experience of managing, $1 billion or more, like, how did you, like, come up with, like, what percentage you should target, and, like, and what was your track record in, like, in growing that money?
So I'm going to ask you a quiz. Okay? And I had got from one of my mentors. There are two investors, Investor A, Investor B. Investor A's track record in the last 5 years is plus 40%, minus 30%, plus 35%, minus 25%, plus 30%. Investors B's track record is 18%, 16%, 20%, 18%, 17%. Who has made more returns?
Yeah, the second guy, because every time you lose money, it really hurts.
That's
and
right. That's right.
Yeah.
So that's your answer right there. If you actually put that on Excel or do the math on that on the calculator, you will see that the guy who's number B, who's the B investor, has done significantly better because of the power of compounding. So our objective is to find businesses like that compound, and we try to make, our average has been about 30% per year. And we try to, hit that number every single year. We did a little better, 36.5% last year. There'll be years when we do a little lesser than that, but that's the number that we try to target. That is the advice I would give everyone. In my starting early years in my career, I tried my best to buy some of these names that I believe would just hit it out of the park. But some of them, did not have the right fundamentals to back them. They don't have the right business momentum to back them. And over the last several years, one of the key things that I've learned is that you need to be able to predict a company or a sector that is going through a supernormal profit phase before others have identified it. And if you can do that when the stock has gone through a series of disappointments, that is the whole recipe of how to make significant money in the stock market. There's nothing more than that.
Okay.
Something has gone through a significant disappointment and now is going into a phase of supernormal profits. That is a way to catch multi-baggers. That is a way to make significant returns. When you can catch 1, 2, 3, 4 such names in a year, even if you have other names which have gone wrong, 10, 15%, it wouldn't matter because one such name would make up more than 6 or 7 names going wrong.
Right.
So it's very important to find solid names that you believe will go through a supernormal profit cycle at the end of a disappointment.
Okay. So no, that's really insightful because a lot of times, like I found myself changing a lot of random names, and you're right. Like if I could make those money of a select names at select times a year and not lose any money, that would be a much better way to grow. Like you said, like option A versus option B, where I'm stuck, like trying to just recover to my base, and I've completely steered away from my investment objective. That's where all that emotion part comes in, which you talked about earlier. But this is super helpful, so like if I wanted to, like so the recap part of what I got from our conversation was that there are different factors you talked about, like trends and things which turn a businesses, volume, some of the things you talk with experts about. So like, and maybe I can try and identify some of those names. But like if I wanted to get help and get this get advice or recommendations from you on how to buy these stocks and grow my money, like is that a service you provide, or like how do I go about that?
So we do. Our minimum ticket size is about a $50,000 number, and we are experts in turning around portfolios and in growing them. So if any of your audience, if anyone wants to reach out to us for that service, they can just go on to our website, which is www.naganalytics.com. You can put that on towards the end of your video, I guess. We will have someone who will get in touch and have a quick call as an introductory call, and take them through our process of how we do it. So we're an investment manager that is always looking for good clients. So yeah.
Okay. And do you operate? Do you operate in the US? And like what is your, what would be your fee structure, or like what do I have to like pay you to help get this going, and how does this work? Like, do you have clients currently? Just to give a little insight into how it works. Yeah.
Sure. So we have an office in New York. We have an office in Mumbai. I typically spend half my time here and a significant amount of time in the US and in other countries. And as an investor, you have to travel, you have to meet companies, you have to do a lot of research. We today manage about $19 million in total. Our fee structure is a 2 and 20. We charge 2% maintenance and 20% profit sharing above a hurdle rate of 15%. So if we haven't made you 15%, we have no profit sharing. The one thing that differentiates us from everybody else is, if the problem in the investment industry today, Shiv, is that even if a client has made a negative return, the fund manager still takes home his maintenance fee. So what we do differently is that if we have made you negative returns in any particular year, we will charge nothing for that year. So we charge a 2% fee for maintenance. We will return that fee to you the following year. So in a year that we have not made our client any return, we don't believe that we should be making any money that year
So
at
the
all.
next return you will give that 2% as
Right.
a fee adjustment, and so that I don't have to pay you next year 2% for
That's
the. Okay, okay,
that's right.
okay, okay, okay. So that's like, so there's a 2% fee, and then if you make more than 50% profit, then you charge 20% of those profits. For example, if I make 20%, I'll probably pay you 1%, 20 minus 15
That's
by
right. That's right.
by yeah. Okay, okay. No, that's that's helpful to know. And then do you have exist, like you talked about $90 million, so like the existing clients, like what's been like, I think you mentioned like 30% or something as a performance, so like what was your performance last year? And like and you told me like that was your track record anyway, 30% or more last year. But like with the clients for this investing business, like what's been your track record like with your clients?
Yeah. So last year we did 36.5%. This year, as we speak, as of yesterday,
Mm-hmm.
we are up 20.5% for the year already. It's been a good year. Mind you, Shiv, it's a very challenging year. This is going to be
Right,
an extremely challenging year for all
right.
traders and investors.
Yeah.
I mean, if there is one year when you need professional help, it is this year. But we've been lucky. We invested well in some themes like fertilizer,
Mhm.
like some of the tech stocks, that we got into early. And so we're up about 20.5% for the year already. We
Mhm.
are obviously hoping to grow on that and have a spectacular year.
Mhm.
I'm not the kind of fund manager who makes 30% and then says, okay, you know what, I want to maintain my track record, so let's not take any more risk. No, that's not how I play. Again, I
Mhm.
detach myself from the
Yeah.
outcome of the
Right.
investment return for the portfolio as well. So it's not just on a stock. Even on the portfolio, I completely detach myself. The reason why I know the 20.5% number is because I was having a discussion with one of my analysts saying, you know what, we need to find ideas. It's been and he goes, wait, you know what, we're up 20.5% for the year. I was like, what? No, we're not. He goes, no, hold on, and so that's
Mhm.
how this number is on top of my head today. But
Right.
typically, I would not know. I would calculate it at the end of the quarter.
Yeah.
So March 31st, so April 1st, April 2nd, I would know what that number is.
I
Um,
see.
right. So yeah.
Okay. No, this is very helpful. At least for the average investor, you've given a lot of good insights. And then for people who do want to invest, and who want to invest like 50K or higher, like you said, at least you have a service which does provide them this this option. But one more thing I want to ask Deep is that like you've been like with these big firms, and you work with hedge funds, and the inner workings of the industry, like some of the things you told us, like so what is like their minimum, like ticket size of like how much they will require if I want to go to like a hedge fund tomorrow and say, hey, I want to grow my money and give it to them, like what is like the difference between them and you, like are you guys the same, like what is what's the advantage right now to invest with you?
It's typically for any established fund, it would be about $1 million. Obviously, it
Mhm.
changes from company to from fund to fund, but the
Mhm.
average number is $1 million. We
Mhm.
have just started out. It's been a year and a half, so we
Mhm.
have that number very low, and we're trying to get as many clients as we can.
Okay.
Yeah,
So,
the
so
advantage that we have is that our ticket size at this point is significantly lower,
okay.
and the other advantage we will have over anybody else is that we will not charge you in a year that you have negative return.
Okay. Okay. Yes. I mean, yeah. I mean that I have never heard of hedge funds giving anyone back money. So like or like a free year the next year if they don't make money. So
Yeah,
that's definitely a good advantage.
yeah.
And so and it's also a good opportunity. So I mean, there is a possibility that as you already at $20 million in a year or two. So like once you are the significantly more amount, your ticket size may go higher too, right? And then it might
So
be harder to get in. Yeah. So no, that's helpful. Like this conversation has been really helpful to me. And just having a clean philosophy to make money is better than being like a one hit wonder, like you were saying. One day you make 50% or something, and then other day you go minus 20, and then again you go 40. Like just this style of investing, as well as just getting professional help, and acknowledging that it requires time, right? Like all the different factors you talked about, they made sense to me, but I don't honestly have time on a daily basis to keep track of that, right? Because I have my regular consulting job, and like in consulting, client is king, right? So once they call, I might ignore something, and then might miss a factor, which you're keeping track of. So this is very helpful. I'll definitely, want to be interested in at least finding out if I can grow my money with you. And but regardless of whether I want to do that or not, like this has been helpful. And if we can have a slide with the information on where people could reach out to if they want to take this help, or even if they just have general investing questions, maybe if we could do like a follow-up call where we invite people, and they could ask you live questions, because I asked you questions which I which I could relate to, and maybe they relate to other people, but they might be questions other people have, and we could have an open forum. Yeah. Okay. Sure. Well, thank you, Sundip, for taking time from your investing schedule, and we wish you the best. I hope we get in before your ticket size goes to $1 million.
Yeah. Well, yeah. Thanks for having me, Shiv. Thank you so much.
Okay.